Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. While I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 or 40 minutes or so. We'll follow the usual format, which means we will check out how markets are shaping up currently. We'll then look at stocks and some of the technicals around the US indices, so the S&P 500, the NASDAQ 100 and the Dow. We'll then go into a quick review of the main risk events from last week. So those include the US CPI figures, the ECB meeting, and also we'll look at the Aussie jobs numbers as well, before then previewing this action-packed week, really. So we have the Fed, of course, the FOMC meeting on Wednesday. We have the Bank of England meeting on Thursday and the Bank of Japan meeting on Friday, as well as some significant CPI data, UK CPI and Japanese CPI just ahead of those meetings, actually. So really blockbuster week, really, in terms of risk events. And hopefully we can pass our judgments and some color on all of that. Firstly, let's go to just how markets are shaping up currently, actually. This is the S&P 500 weekly chart, but before we get to that, just checking out markets actually at the moment. It's kind of broader sentiment, quite slightly muted, really. As I said, traders really waiting. We're all waiting for this raft of policy decisions this week from across the globe, from the likes of, actually, if you look at it, from Mexico, Brazil, Turkey, China, plus then European central banks, the S&P, the Swiss, that is, the Riksbank, Norges Bank, and the big three as well, of course. So the Fed, the Bank of England, and the Bank of Japan. In all, I think that 6 of the G10's central banks are in action. And really, we're thinking around the current narrative, which is one of a resilient US economy really pushing this higher for longer rates theme. We'll go into it, of course, in more detail. Just this morning, interesting, fixed income is getting some focus. The US 10-year Treasury yield, which I'll just put up here, actually, so you can see that hit fresh highs, actually, for the move, cycle highs in the US 10-year Treasury. That's basically a global proxy on borrowing costs. A new cycle high this morning, as I said, around the 4.35 mark. Let me just show you here. This is the chart here for the 10-year. Yeah, up to 4.41, actually, for this US 10-year Treasury. So really interesting move, but we have pulled back off that high, and we're just trading around that sort of 4.34 mark in that previous high seen back in October last year, which we touched upon actually in August around the sort of 4.33 mark. So whether that holds as resistance, we will no doubt see surely in this week with the Fed meeting and its dot plots as well, which obviously show what Fed officials are expecting in interest rates going forward for this year, next year, 25 and actually 26. We get some new projections as well. Really, it's due to higher energy prices actually impacting, of course, inflation expectations and then pushing these yields higher. If we just look at oil, actually, you can see it's a weekly chart, actually. Let's just go to the daily. Yeah, you can see we're pushing up towards $94 here, 94.13. This is Brent. So those are highs for the move, of course. And then if we just drop back to, yeah, this is the daily chart. Actually, you can see that spike high up to 4.41 in the 10-year Treasury. We're just back towards then this resistance line. And if we just pull it back, that goes back all the way to that October high as well, which we mentioned. As for FX, kind of relatively rangy, really steady start to this action-packed week. Dollar trades a touch softer in early trading. Most currencies except dollar CNH marking a small comeback, really. Kiwi, Aussie led the board in Asia. Dollar yen Just checking, retreated back to sort of 147.60 after rising back to highs of 147.95 on Friday. Euro dollar, that remains below 107, obviously following the dovish hike last week from the ECB. Cable, that's sterling against the dollar, trades around 124. You can see with the path, obviously, for the Bank of England in huge focus this week with the meeting. Dollar CAD, that is trading just above 135 as oil prices obviously continue to rise. That's come off its highs. Of course, dollar CAD going lower as the CAD appreciates with those oil prices rising, as I mentioned. Dollar CNH rising, yes, just above 129 from the lows of 129, 125.96 after the P-box liquidity enhancing measures, more stimulus on Friday. Just touching on those commodities then, US data resilience, additional China stimulus measures that I mentioned really have pushed Brent higher. Supply outlook remaining tight into year end, obviously with those Saudi and Russian oil output cuts really impacting on Brent and WTI, and especially for diesel amid really a lack of diesel-rich Middle East and Russian crude. So the demand outlook is also going to be key. I think later today we do get the Saudi energy minister, speaking in Canada. Gold as well, showing quite decent resilience really in the face of the rising dollar, of course, and rising yields. It's returning to test. Let me just check. We'll pull up the chart for you. Yeah, just returning to test sort of 1931. That's the 50-day moving average, which kind of capped the upside previously, although we went above it, but then moved back below it, and we're still below it. And we're trading, of course, just around that black line, which is the 200-day moving average. 1922, you can see there, which sort of has offered some support around this sort of level. But the recent low, 1901, 1900, and then we get towards that sort of big fib level around 1894. That is gold. Okay, just moving on to stocks then. Just pull up the S&P 500 chart. Just bear with me 1 second. Yeah, this is, we normally go to the weekly. Actually, we like to show you that. Futures surprisingly trading still around sort of 45.04 level, despite that breakout in the US 10-year yield, although, of course, that has pulled back now with oil prices slightly pulling back off their highs at least. Last week, well, we saw another week of defensive sectors really outperforming cyclical sectors, suggesting possibly a turn in the markets. Wall Street fell on Friday as signs of weak demand from the world's top chip maker really hit mega cap tech shares. The benchmark S&P, that dropped, as you can see, 1.2% on the day. Tech-dominated NASDAQ, that fell 1.75%, which meant then for the week, the benchmark S&P index only shared actually 0.2%, just checking there, while the NASDAQ shared 0.3%. As I said, technology shares really led the market lower. That was the report by Taiwan's TSMC, had asked its major suppliers to delay the delivery of high-end chip-making equipment. And that hit as well the SOX, if any of you follow that. So that's the Philadelphia Semiconductor Index. That tracks basically the 30 of the world's biggest semiconductor manufacturers, and that fell 3%. Okay, regarding technicals then, let's just see. We've still got this bullish channel in here. We probably should take it out now as we're sort of traded outside of it now, but we're still sort of in this steady uptrend. Interestingly, I think on this weekly chart, you can see these inside weeks. So basically, the high and the low of the previous week is inside that previous week. And you can see there's happened on a couple of occasions, kind of just denotes consolidation, range contraction in a way, and potentially denotes the the possibility of a range breakout, so range expansion, because prices are compressing in a sort of narrower range. We will at some point get, as I say, range expansion. Generally, that should be in line with the dominant trend, which you can see is for higher prices, but we shall see what happens for us then. Probably support comes around the recent low, I guess, 43.35. That is a major low really there. And then upside will obviously take into account the recent high at 45.41. And then of course the late July top at 46.07. Even above that, then you've got this swing high that we put in here around 46.37. If we do break in line with the dominant trend, which is on the S&P. NASDAQ 100, in fact, bear with me 1 second, we'll just go to the daily. Yeah, you've got the 50-day moving average, 44.82. Hasn't really sort of denoted, has previously denoted some sort of support, but we're sort of below it and oscillating around it really. So as we say, 45.41 is resistance, that's September high. And then near term support 44.30 before then getting towards that middle of August low at 43.35. You've got the 100-day moving average. That is the grey line there at 43.63. Just on the NASDAQ, if we go to the weekly, again, you've got these two inside candles. So denoting sort of indecision slightly, but consolidation for sure. Smaller ranges and then potentially moving higher if we do break to the upside. So you've got near-term resistance at 15.618, and then you've got that cycle high at 15.932. Again, should take out this ascending channel. Now we're out of it. Let me just do that now. If we just go to the daily as well, you can see actually, yeah, 50-day moving average, we're oscillating around there. If we lose that near-term support at 15.138, then we go potentially down towards sort of 14.700 or so. That's the 100-day moving average, as well as a sort of near-term fib level just below there, 14.696. Just looking at the Dow then, you can see on the weekly, again, well, we don't have a couple of inside weeks, but we're holding above 34.281. Many of you will recall this level, of course, which we've been pointing out for quite a few months now. You can see that sort of resistance, and then now sort of acting as support. Potentially we dipped below there, but didn't really close above there late August, and now we're just oscillating between there 34.281 and this sort of swing high at 35.492. So those are the levels that we are watching on the Dow. Just one stock we would like to highlight is Apple. Just bear with me 1 second. I'll just pull that up for you, which is here. And if we go to the daily, that's Amazon, sorry. Apple, yeah, you can see just potentially key support at 171.96 in Apple, kind of where Apple goes, the market goes because of its weighting and its market cap. So just be wary. We're wary of this level 171.96 as strong support. And as well, if we just show you this gap now that has developed, we don't often put this, in fact, is not going to work for me. Just bear with me 1 second. It's not going to work for me. But if we overlay the S&P 500, sorry about that, then onto Apple, it's the biggest, widest gap that we've seen because it generally tracks that. Widest gap we've seen year to date. So again, just something for us to keep in mind, or we are keeping that in mind, and that 171.96 level, if that acts as strong support or not. That is in Apple, and then potentially sort of the wider indices. Okay, just bear with me 1 sec. I'm just going to now, we're just going to revisit the main risk events from last week. And firstly, in fact, you can see that now, apologies. Firstly, yes, US CPI figures, big data point, of course, they came in slightly hotter than expected in August. This was obviously last Wednesday headline. rose actually at the fastest pace since June of last year. So 3.7%, you can see on the graphic, year on year, 0.6% month on month. That annual figure was 1/10 higher than forecast. But certainly the headline surprise, primarily driven by that 10% jump in gasoline prices, because then if you strip away the volatile sort of energy costs, food as well, the annual core rate that fell to 4.3% from 4.7%. And then notably for us, we talk about it a lot, the core month-on-month reading needs to be around 0.2% to bring inflation back to the 2% target. Printed at 0.3, if you look at the figure in details, actually 0.278%. So not a terrible miss from that consensus 0.2 estimate. And certainly then that kind of means 3 consecutive months around the 0.2% mark, which will, we would think, certainly please the FOMC policymakers. Interesting, the market reaction after the data was quite muted, really, probably just the case of rates and FX having priced in sort of above consensus CPI prints ahead of the release. And it probably didn't alter really flagged Fed plans to keep rates stable, of course, this week at its meeting. We'll talk about the energy, the impact of this shortly when we look at the Fed rate decision. Of course, it's around rising energy prices, potentially acting as a risk to the headline rate, and that then may complicate this sort of global disinflationary process that we're seeing in the coming months. Whether that affects the core rate, which obviously excludes it feeding through to sort of higher transportation costs, services costs. That is obviously the $64 million question in a way. Yes, so that was CPI, the report. And then we got, of course, just bear with me 1 second. We got the ECB meeting. So that was the US CPI, as I say. We then got the the ECB meeting. And I'm just pulling up a Eurodollar chart here that you can see. ECB meeting Thursday, of course, that raised the policy rate again by 25 basis points to a record 4% for the deposit rate. That was its 10th straight rate rise. Makes a total actually of 450 basis points, because if you remember, we started at negative 0.5% with the ECB. So a total of 450 basis points since July 2022. And the big but, the hike really being labelled now as the final dovish rate hike. So a dovish hike by the ECB. In advance, the decision was said to be a close call. And ECB's Lagarde at the press conference, she admitted that some members already preferred a pause, but in the end, the decision was supported by, as she said, a solid majority. Really, as inflation, while easing, is still expected to remain too high for too long. This assessment was then supported by an upward revision in 2023 and 2024 of inflation projections to 5.6% this year, 3.2% next year, and then even in 2025, just to note, it went from still above the ECB's target, which is a key thing to note, 2.1% from 2.2%. So that's in 2025. At the same time, growth forecasts were substantially revised down, 0.7% this year from 0.9%, 1% in 2024 from 1.5%, and then a small adjustment in 2025 to 1.5% from 1.6%. So in this context, and I'm quoting here, actually, the Governing Council considers a key ECB interest rates have reached levels, and this was a key phrase, that if maintained for sufficiently long duration will make a substantial contribution to the time return of inflation to target. President Lagarde, she mentioned this paragraph, this phrase numerous times in the press conference, and that really signaled to markets that the ECB will now remain on hold with then rate cuts from potentially from the second quarter of next year. Of course, Lagarde emphasized the bank is still data dependent, and this will, but this that is probably key because that will be used to judge how long rates will be kept at such restrictive levels, and that's as opposed to how high rates will go and whether we would see another hike before reaching the peak. So we sort of shifted the dynamic now with ECB, that dovish hike, and this change from how high rates go to then how long they will stay at the peak. And going forward, well, we kind of think Lagarde will probably switch to kind of trying to defend that higher for longer stance then to fight inflation, which means she'll kind of be on the hawkish tilt, if you like, on the hawkish with a hawkish bias, and then possibly then pushing back against rate cut speculation, especially if the data deteriorates further, which we have seen. I think it's interesting. We have had, of course, ECB speakers out on the wires after the meeting on Friday. And those were mainly hawks pushing for the idea that the ECB's work isn't done just yet, and potentially, sorry, just bear with me 1 second, just checking what you can see here. Potentially then, the ECB's work, is not done, and this is what the hawks have been pushing for, potentially a hike in November or December, and they're pushing that for being one more 25 basis point hike. Just looking at the euro dollar chart, then you can see, and again, really interesting, and really not a good look, not great optics really for the ECB. They hiked by 25 basis points. It was a surprise because it was kind of a 50-50 call beforehand. And yet euro dollar dropped 0.8%, which I think was its sixth worst one-day performance this year, one-day loss this year. So not a good look for the ECB, even though obviously they were trying to keep up the pressure on them, keeping the door open or telling us that they were data dependent. But for sure, it was that phrase that I mentioned earlier, which really put markets on alert that this is the last hike that we will see. You can see just in euro dollar, really nice descending bearish channel there. So series of lower lows, lower highs. Haven't really touched out of it. We did possibly, as you can see, late August, push out of it, but then swiftly that 100-day moving average, which has now fallen to 108.90, but was around the sort of 109 level. That capped the upsides, and then we're back in this descending channel. Should really stretch it out here just to see where potentially we go next. So still in there, we have for us this May low at 106.35, which will be key initially, which we kind of, we touched on Thursday. 106.31 was the low on Thursday, 106.33 the low on Friday. So that's a key level of resistance. Key level of support. I'm just trying to pull out then this long-term fib level, which we then get, which is, you can see, the retracement level of the decline, 2021-2022 decline, and you can see long-term fib level 38.2 at 106.10. So 106.30 region, then 106.10, key for support. If we lose that, then we're down to these lows here, which is sort of the March lows around sort of where I 105.16 and 105. Just below there, 105.24, 105.24, 105.16 or so. If we do push below the 106.10 level, 106.35 level. So some key levels for euro dollar as we look towards, of course, the Fed meeting, and certainly We don't have a lot of data before that meeting on Wednesday. We do have the Eurozone PMIs, which will probably not be pretty, meaning that certainly before then, the euro-dollar or euro-dollar will be driven by any dollar movement for sure. Okay, let's now look. I was going to look at UK employment figures because they are important, of course, for the Bank of England decision, but we'll probably touch upon those. Not wanting to go into too much detail with those, but touch upon those when we get to the Bank of England. Also said I'd look at briefly the Aussie jobs numbers. They were stronger than expected. Employment rose nearly 65,000 actually, so crushed that 25,000 estimate after July's, remember that negative reading. Unemployment unchanged at 3.7%, so close to the record lows of 3.4%. Again, that was seen last October last year. Important though, the hiring spike was almost entirely related to part-time jobs. So yeah, just bear that in mind. But of course, some of these jobs will become full-time in the coming months, which then would potentially push wages a touch higher. Interesting, the sort of this blockbuster report, really strong jobs figures, didn't really change pricing for the RBA. I think there's around 8-9 basis points of tightening now to the peak. So it doesn't really alter the expected outcome for the next RBA meeting, which is October the 3rd, I think. Rates really seen staying at 4.1%. You can see now just on the Aussie dollar, again, I've kept in this sort of sideways channel, which we broke obviously down below 66, 68 sort of channel. We're now below that firmly and sort of trading still below the May low at 64.58 there. So we're trying to sort of build a base around 64. If we pull it back, you can see again a fib level, minor fib level at 63.81 as well, acting as support. So sort of support around 64. If we can build that base, then certainly near-term resistance would be at these sort of highs from the start of September, 65.21 and 65.22 end of August. And then if we can push above those, then we do have that 50-day moving average quite some way away, 65.50 before then pushing back up towards that long-held range, which we have obviously, as I said, broken down through. Otherwise, near-term or very strong support, as I say, 63.81 and just around there. If we do lose that, then we're back to potentially those November lows at 62.72. Okay, that's the Aussie dollar and the Aussie data. Now let's get to the Fed, of course. Just bear with me while I just get firstly the graphic, which we like to show you. The main numbers for us. So really after 8 weeks now, has it been 8 weeks since the last Fed meeting? A long time really. The Fed widely expected, you can see 99% chance with the CME Fed Watch tool. So Fed Funds Futures basically pointing to a definite unchanged decision by the FOMC. Rates will be kept at 5.25% to 5.5%. So that's its second pause of the year. Of course, in July, the FOMC raised rates to a 22-year high, but really thinking is now that the Fed keeps its powder dry after this summer break, probably preaches a sort of patient higher for longer stance with a possible hawkish flavor. Certainly, Chair Powell will not pre-commit to any policy action. That will certainly probably disappoint those looking for a peak in rates and also then squash thoughts really that rates are likely to fall anytime soon. Instead, he'll highlight the relatively healthy state of the economy with moderating labor costs, which we've seen in the form of falling employment, the falling employment cost index. We've also had lower average hourly earnings growth and then easing labor demand. And you can see I put in there the 3-month average in the non-farm headline payroll, number around 175,000. So that's been cooling from, that 3-month average has been up 300 or so. So definitely easing, and that balance between labour demand and supply is also nicely balancing out as well. We then had, as we mentioned, that cooling inflation, which we have highlighted in detail just a few moments ago. Certainly Powell will be conscious, though, of this recent run of hot activity data, and only last week, of course, we had higher retail sales, although a chunk of that was due to higher gasoline prices, but still the 0.6%, sorry, retail sales last week. Strip out the gasoline prices around 0.2, so that's still higher than expected. We also had better than expected PPI data, and then we had again lower initial jobless claims. So you'd kind of think Powell won't be able to declare victory in his fight, in the Fed's fight against price pressures and inflation. And obviously that bump in the road of disinflation that we've seen, with that tick up for a second consecutive month from 3% to 3.2 and then 3.7 in the headline, due to rising energy costs, which will be a factor potentially. But as I say, it's whether they then feed through into the core and other sort of services inflation as well. I have mentioned here the dot plot. That will be key, we think, for markets. We do get an updated summary of economic projections, so the SEPs, as well as fresh dot plot of basically where Fed officials, 18 Fed officials, plot basically where they see interest rates going this year, 2024 and 2025. If you just cast your minds back to June, that saw that lift in the dot plot to 5.625%. That's basically the median between 5.5 and 5.75. So if you remember, that went up from 5.1%, so now to 5.6% or so June. So very unlikely that they take that out for sure. And probably they don't change that. So still one more hike expected by the majority of Fed officials. Remember, it's a median dot plot. Although markets slightly more skeptical, they give around a 40% chance that we get that hike by sort of probably November or December, mid-December, that meeting. And remember, the November meeting, 1st of November. So only around a 40% chance, just less than that, I think now, of another hike by the Fed, probably in December. So just something, again, to bear in mind with these dot plots, and whether they change at all. For the 2024 dot plot, I should say, that is, or had signaled 100 basis points of rate cuts. So possibly, potentially, they change that, and there is possibly a revision higher of that plot, of the median plot, that is. But I think most not really expecting that, but just expecting the Fed to keep in that one more rate hike for this year. I mentioned the SEP as well, so that's the economic projections. Really not a massive amount of change, just revised upwards will be the GDP figures for this year, substantially revised upwards, actually, possibly to around 2% from 1% in the June projection. Otherwise, probably not many tweaks to the forecast for growth and inflation. Possibly PCE inflation comes down, while headline inflation possibly ticks up. That is for this year. I think interesting that the one hike, just going back to that, actually, the Fed will be conscious that we have seen 3 prior soft patches in inflation already, well, kind of since the pandemic, but then those patches have been followed by a re-acceleration in price pressures and inflation. So they will be conscious of that. That's one thing to note. And then also, I think it's worth bearing in mind, really, the market will focus on the current year dot plot. That really tracks decisions much more closely than, say, the outer years, 24, 25, 26. And so a market reaction will possibly react to those, but then probably fade the outer changes, if you like, because just remember they are sort of guesstimates by Fed officials, and it's probably the current year which is most significant. Okay, hopefully that's clear for you guys. Of course, I should say, if you do have any questions, please do ask them along the way. You can see here then really interesting Fed funds futures, basically plotting or interesting for us that the markets and the Fed now converge really. So they thinking the same thing. If you remember through this year, really, we've had markets expecting more rate cuts than the Fed. Chair Powell has consistently batted that back and said they weren't looking at cuts at all, and then the market has had to adjust that view. But now we're sort of in line. They're converging, the Fed and the market, with rate cuts then coming towards sort of, that's been oscillating depending on the data, but sort of coming towards sort of July time being the first rate cut that markets are seeing. When we have had stronger data, that's sort of been pushed back from sort of June, May, even when we've had the soft data, which markets were thinking we'd get the first rate cut, but then with the stronger data being pushed out, further out into 2024, and as I say, July or so. Just checking what else I should mention. I think going forward will be important really is the fact that, well, financial conditions have tightened over the summer. So that's sort of not least reflected in higher lending costs, higher mortgage costs, then stronger dollar and higher oil. And certainly now we're getting less credit availability. And then going forward, I think it'll be interesting to see whether Chair Powell mentions the sort of potential headwinds on the horizon, and those being things like pandemic era savings are now starting to be run down, and also we get the repayment of student loans that's being restarted, and then potentially we're getting sort of rising credit card and loan delinquencies, auto loan delinquencies, that is. So potentially then that impacts activity going forward towards the end of the year or closer. And then that implies possibly attention, as I've mentioned, will be around those projected cuts of 100 basis points embedded into the most recent median 2024 plot, as I said. Okay, hopefully that's clear for you guys. I just want to show you one more thing before, well, let's firstly look at the dollar index. So just bear with me, I'll just pull that up. But certainly the dollar will be prone to sorry, bear with me one second. Sorry, bear with me one second. I'm just checking what you can see. Apologies. Yeah, here you can see the DXY charts. But just going forward, yeah, for sure, we will get volatility around the dollar across the meeting, especially then if the economic projections or the dot plots, especially that near-term 2023 dot plot, sees big revisions. Just on the weekly chart, really interesting. 9 consecutive weeks now of gains for the dollar. It's very rare. Streaks of this type stretching into double figures is very rare. And it's very rare in major currencies, I should say. And really, so the broader trend potentially could be ready for some consolidation. Interesting, if you see here, we're also now up against this resistance level, which is 38.2 retracement of the October 2022, July 23 drop, which you can see there. That's a 105.38 on the DXY. So really interesting with these consecutive run weeks of gains now, whether that pauses. You can see we're not overbought on the weekly RSI, but on the daily we are. Doesn't mean we can't go higher, of course, on the daily. And you can see that dotted line there, 105.38, which is that fib level. And then we've got otherwise the March highs at 105.88. So we're very close to the year-to-date high, but not quite yet. And really interesting whether then Powell is slightly more hawkish than expected. I think the bar in a way is quite high for him because this hike is already in there. So whether we probably need to see semblance of, that definitely firming up for a hike for this year to sort of keep this rally going. And then we'll come into resistance around that March high, as I said, around 105.88 or so. I should mention, actually, just before we get there as well, we've had the consecutive streak, of course, in euro dollar. So 9 weeks there, I think. And going back, I couldn't actually see anything until around, where was it, 1994, getting a sort of similar losing streak. So just bear that in mind. I think a lot of people are hawkish and hoping Chair Powell is hawkish as well. So expectations, possibly he has to, step up to the plate really and affirm those expectations. Okay, hopefully that's clear for you. And the DXY chart. Let's now just go to the next major central bank meeting, which is, of course, the Bank of England. Again, just bear with me 1 second. Okay, here's the graphic, and we are likely to see the Bank of England raise rates for a 15 consecutive time at their meeting on Thursday, taking rates or the base rate to 5.5%. The vote probably won't be unanimous. We have Dhingra most probably voting for no change, possibly outsized chance that the Hawk Man, she could vote for a bigger rate move as well. Just thinking about the previous meeting in August, the MPC slowed the pace of rate hikes to 25 basis points, kind of judged that policy was now restrictive and so bearing down on inflation and growth. It then also said it remained data dependent and pledged to keep rates sufficiently restrictive for sufficiently long. Since then, the chances of another rate hike have kind of been reined in slightly over the recent weeks, really due to a series of softer data prints. I've got one in here, so that's the PMIs. The composite fell below 50, which denotes, of course, contraction after services dropped to 49.5 from 51.5. We also had GDP that printed at negative 0.5 month on month in July. That was actually the first time since June 2022 that all three main sectors have contributed negatively. But the issue, of course, for policymakers is around inflation. I've got the number from the previous report, 6.9% there, which obviously fell from the prior 7.9%, but it's still, of course, elevated, still sticky. And of course, the two sort of variables, the two most important variables in the Bank of England's sort of reaction function is services inflation. That's still very lofty at 7.4%, rose from 7.2%, I think, in the last report. And then, of course, as well, the other key variable for the Bank of England is wage growth. Private sector wages, especially, they remain high, around 8.2%, and then private sector wages at 7.8%. So still very high and exceeding as well. Let's not forget the MPC's forecasts. Just want to mention one other variable as well. That's tightness in the labour market. Interesting, actually, that with those job figures last week, we got a bigger than expected fall in employment. So whilst we also got, a rise in unemployment as well. Unemployment moved from, I'm just checking here, rose to 4.3% actually. 4.2% unemployment rose to from 4%. So just an easing in the tightness in that labour market in the UK. So interesting to see how the Bank of England will respond. Peak rates now, then they're at, well, around a 5.6% mark. So if we get that 25 basis point hike, then only sort of 10 basis points or so, sort of 40% chance of a rate hike. Of course, they're come down massively from market expectations earlier in the year. And I think there's around 40 basis points come out of this tightening. Just 40 basis points really only over the last month or so. So big correction in Bank of England rate expectations. If we think around Governor Bailey, he has softened his stance as well recently, saying the bank is near to the top of the tightening cycle, and we're no longer in a phase where it was clear that rates needed to rise, and that the fall in inflation should continue. That has, of course, hit sterling quite severely. We'll look at the cable chart very soon. I think cable's fallen around 5.7% in just 2 months from that high we saw in July, around 131. Data dependency optionality by the Bank of England, probably that won't help sterling either, with the economy, as I've mentioned now, starting to roll over. The flip side, I guess, is whether we see the bank strongly reaffirm the policy to remain restrictive for some considerable time, and whether there is a sort of support, a bolstering of bets around another hike, possibly in November or December, if sort of price pressures remain too elevated. Of course, we do get UK CPI the day before. This is a graphic of the CPI figures that we have seen. Expectations then from these figures, seeing headline actually increase to 7% from 6.8%, while core is seen falling to 1/10 to 6.8% from 6.9%. Headline, again, like the other inflation reports we've seen around the globe, driven by energy-related inflationary pressures. And interesting whether the UK will be affected by that. As I said, US, Eurozone, certainly affected by that, but some nations have avoided this upside. And it kind of remains to be seen how long-lasting that will be, as I've mentioned, and whether then it affects the core figure. Yes, that is CPI. So remember, that is on Wednesday morning, UK time, 7 a.m. So the day before the Bank of England decision, and of course, just ahead of the Fed meeting as well. I think going forward, looking at pricing, around 40% chance, 35% chance of further tightening post this meeting. So that, as I said, around a 40% chance, 25 basis points delivered November, December. Of course, a major downward surprise in the August data could possibly be sufficient for the Bank of England to leave rates unchanged, possibly on Thursday. But yeah, bear in mind as well, I guess we had those remarks from Bailey, from the chief economist Pill as well, and possibly then some of the welcome nuances around that wage data and the employment data as well. Let's just look at cable now, just briefly. Just bear with me 1 second. I'll just pull up the chart for cable, which is here. Just pull up the weekly, which you can see again, bearish channel. You can see that fall from the high, 131.42 or so, the high from July, and then this quite severe fall, really, as I say, around 5.7% or so, bearish channel. And we're in there. We've just dropped below the 200-day moving average at 124.34. And just this morning, actually, we hit a 15-week low at 123.70, although we sort of bounced back slightly, but still below 124. So you've got a fib level here around 123.14. That sort of tallies with then the May lows around a similar 123, just above there. So that will be a target for the bears, if you like, and if Bailey really doesn't see or closes the door to any more policy action. Again, remember what happened to the ECB and the euro. a sort of hike, but a dovish hike. And of course, the euro dropped quite sharply. So potential for that to happen, and then look for support around 123 and just above. Okay, finally, sorry, we are trying to get through this, but there is a lot to get through, of course. We'll just touch upon dollar yen and, of course, the Bank of Japan meeting, which is here. Really interesting. We also get the CPI reports, of course, August inflation on Friday, as well as the rate decision by the Bank of Japan. Yen volatility really can't be ruled out, with sort of dollar yen pushing up towards its recent highs, around sort of high side of 147.87, you can see, and the high from Friday at 147.95. Of course, the Fed meeting will affect this strongly, with those treasury yields really having a high correlation to dollar yen. Don't forget that. Touch upon inflation. First of all, Japan inflation unlikely to create a sort of clear case for sort of a more hawkish stance by the Bank of Japan. Certainly as well, Ueda's recent comments to bring forward the policy review timeline kind of did support yen, but those have sort of been backed away in more media comments actually end of last week as well. Remember, he sort of brought forward expectations of the end of NIRP, so a negative interest rate policy, to sort of January from September next year, though, as I say, that support has faded now. Headline inflation then expected to tick lower, actually, to 3% from 3.3% on Friday, and the core measure seen stable around 4.3%. Of course, higher oil prices, fresh round of fiscal stimulus from the government, could push price pressures higher into year end, so something to bear in mind. As for the Bank of Japan, fully expected to refrain from any policy changes after, if you remember, July's move to widen the 10-year target band. That was the curveball last time, and there was a lot of volatility around it initially, but then really it was seen just as a move to continue monetary easing without disruptions, and really not part of any exit from the ultra loose policy. As I say, we've had those comments from Ueda, but sort of then other comments sort of backing away from that. And I guess looking forward, probably more likely, if anything, we get any changes possibly in late October, their next meeting, which is when we get the new economic forecast from the Bank of Japan released. Otherwise, yes, dollar yen will be impacted hugely by the Fed, of course, with resistance of 147, just below 148, basically. Otherwise, if we do push above there, then we're looking at, of course, these highs from sort of autumn last year, 147, 149.71. That high from October, 150 is the obvious level here, and then we're getting into major intervention territory with that high you can see at 151.94. But this will certainly bring on more loud jaw boning by the sorry, I didn't show you the chart. Sorry, here's the chart. Apologies about that. Dollar yen chart. You can see us bumping up to those highs now, around 147.87. And then if we look at the weekly, if we do push above that, then we've sort of probably got the October high from last year, 149.71, before certainly 150, big barrier everybody knows about for intervention, with that higher 151.94 being a trigger. Well, the trigger was before that, actually, when obviously Japanese authorities spent around 60-70 billion yen defending the currency, and then it pushed dollar yen sharply lower. So that will be impacted, as I say, by the Fed, of course, with 148, then 150 sort of in line for being resistance levels. Okay, that is all we have time for now. I was going to show you the global chart, but I've been rattling on. So hopefully that's proved of use to you guys. Please do follow us on social media. You can see where you can follow us as well. We do publish a daily market report after the US close, ahead of the Asian Open, which has a look at the US markets, as well as then a look at the day ahead and also a chart of the week. Okay, take care out there. A lot of big risk events. So just check your position sizes for sure. And also just your risk management around any orders you do enter. But volatility is expected, which is certainly exciting for trading, but also just be wary of the moves that can take place. Okay, all the best out there, and we'll speak to you next week.